Hi all, and welcome to video number 4 of our series, What is Day Trading? Day Trading Explain. How much money can you make day trading? Is day trading a business? Is day trading basically a job? Is day trading a fun type of business where you can do it from the beach with your eyes closed and drinking pina coladas? So I hope that we answered all those questions until now. And now we need to get more in depth into what really is the business of a day trader. If you remember, during the last example that I gave you in the last chapter, which was chapter number 3, I asked them, okay, this is the stock AAOI. You have the opportunity to buy it at 28. It goes straight to 31. You're going to take some profits on this move, and you're going to have a stop loss, and you're going to probably will make money, but that's not the real question. The real question is, how do you, as a day trader, are coming to acknowledge that this is your trade? This is buying, let's say, 100 shares of AAOI at $28. And you use the stop loss at 27.77, and it goes from 28 to 31, and on the way up, let's say you sell it at 30, and you make on 100 shares $2. That's $200 of profits. That's fine. But how do you get out of 6,000 stocks to look at AOI? Again, there are so many fish in the sea, but the fish is elusive. I mean, they're not waiting. Nobody's going to give you a call. Okay, please, we're waiting. Buy AOI at 28, and it's not happening. Okay, so you can see here that the stock basically trades under 28 for about each bar here is 3 minutes. So let's count 3, 6, 8, 12 minutes to the most. So that's the time frame that you have in order to analyze and enter the trade. If you're looking at AOI, obviously if you're looking at somewhere else, you're not going to trade the AOI. You're going to look at somewhere else. And maybe there are better trades somewhere else in the market. Maybe Nvidia during this period is moving up $5, or Netflix is moving up $20, and so forth. So again, this is one of the phases that a day trader needs to go through, and how do you reach the best trade? And after you reach the best trade, how you manage the best trades. But before all that, you need to acknowledge that trading or investing is about taking risk. Taking risk meaning you buy a position, let's say for the heck of rounding things up, and the position is worth $10,000. If it moves up 1%, you know how much is 1% of $10,000, so you made $100. If it goes down 1%, it deducts basically $100 of your position, which is then going to become $9,900. The question which every business has to ask is, how much I'm willing to risk for a trade? And a trade is your business as a day trader. So are you willing to risk $100 per trade, $200 per trade, an unlimited amount per trade, 1/3 of your account per trade? So all this decision needs to be made before you enter the trade. Why is that? Because stocks sometimes move very, very fast. Okay, sometimes they can move 1% per minute. Sometimes they can move more than 1% per minute. Sometimes they can move 5% per minute. Again, these are not normal times when they move more than 5% per minute, but it can happen. Anyway, you need to have a plan, and the plan says, okay, I'm buying a $10,000 position at price, let's for the sake of this example, let's go with 28, and I have a stop loss in the platform at 27.77. So the scenario, the worst case scenario will be, I'm buying the position at 28, it goes down to 27.77, and I'm losing, in this case, 22 cents per the position. Let's say the position was 400 shares, so 400 times 20, that's let's say $90 on average. Okay, you're fine with that, but another trader will say, I'm not about to lose $90 or $100 per position. I want to lose only $50. Another will say, I have a huge account. I have 200 grand in my account. I'm willing to take more risk. I can lose up to 1,000 or maybe 2,000 per position. All those decisions need to be made before you enter the trade and should be based according to your rationale, because it's your business. Normally we suggest, that's the motto here at the Charts Maverick, to take positions and risk up to 1% on the position. That's our advice to traders. Okay, but again, this is our advice. We're not managing positions for anybody. We're not in the business of investing or trading. We're in the business of being advisors or teachers or mentors. So the idea here is that we suggest that you take a risk of no more than 1% per one position. So if your position is $50,000, because that's your decision, we suggest you risk no more than $500. Is it doable under US equity markets trades? And the answer is, of course it's doable. Not in every case, of course, but most of the time it will be doable. So in this example, you see an example where AOI enters, the entry is 28, the risk is 23 cents, meaning it's less than the 1% risk, which is in this case 28 cents. It fits the strategy that we advise. But again, it's we are advising, but we are not managing your position and not your account, and we are not responsible. You are responsible. And again, how much money you put to work? $1,000 per position or $50,000 per position. Again, the decision of the day trader. So a day trader is basically a business that needs to manage money. It cannot be done from the beach. It cannot be done while drinking pina coladas. It can be done using a laptop, a 3 or 4 light screen where you observe the market, some stocks anywhere between 6 and 10, hopefully more in time. You also look at some indicators, and based on that you work anywhere between I would say 4.5 to 5.5 or 6 hours per day. Not very hard work, but it is a complicated type of job where you put to work money, your intelligence, your willingness, your ability to take decisions fast, and your ability to take matter in your own hands and sometimes make decisions that are not very pleasant, such as cutting losses or losing more than you expected. So things can go wrong very fast if you don't have a plan. Bottom line, what I want to basically summarize here after basically spending half of this video is that trading or day trading is a business, and you need a business plan. And the business plan is based on your decisions, such as any business plan. If you are an Uber driver, you have a business plan. You know how much gas and the car and the wear and tear, and how much you're getting paid from Uber per kilometer or per mile, and you decide if you want to take the ride or not. And if you are a dental surgeon, and you know how much money is going to cost you to invest in your practice and have a whatever practitioner next to you, and all the materials you need to do in order to perform whatever procedure you need to perform, and that's why you charge the patient, let's say $1,000. The cost to you is $500, and you make a net profit of $500 per that 1 hour or 2 hour whatever procedure. In day trading it's the same, only that things go very fast. So you don't have a patient sitting in your chair as a dental surgeon, and you work on him, and 99% of the time things will be fine, and you cannot lose money. You may, sometimes things can go wrong with any business. Here things can go wrong as well. You're not going to hurt anybody. You can hurt your pocket. In order to avoid hurting your pocket, you need to build a business plan, and it needs to be very strong. And then you need to apply your business plan. But the question is, when do you apply your business plan? So let's say you apply your business plan after buying it at 31. Is this a good entry point to buy this stock at 31? Most of us will say obviously not, and I will say obviously it's not a good entry point, because the stock moves 1 cent over 31 and then drops like a stone. Where was a good entry point? Maybe 28, but there were plenty of additional entry points. Anywhere between 28 and 31, it's $3. Where is the best entry point? Maybe there are better entry points than 28. Also, the stock started to trade well before it reached 28. Bottom line is, day trading is a job that needs to be managed, observed, and practiced, and it can be a very, very successful job if done right. Now, in this chapter, we already talked about the risks involved in buying a position. Now let's switch to the profits. So let's say you take care of the risk, and you know that your worst case scenario when you buy a position and the trade gets against you, you're going to lose a fixed amount, let's say $200, okay, on any position. It can be done most of the time. So you're going to lose a fixed amount of $200. Okay, but now the stock starts to move from 20. You can see 28 here, and you can see the price action. You can see it from 28, it goes to 29, it goes to 30, it goes to 31, and then drops later from 31 back to 29. Sorry. Let me just point it. So that's 29. And so basically the stock comes back down to the 28 level, from 28 to 31 and back to 28. So on the way up, where do you sell your position? Do you have a plan for that? If you have a plan for that, then you are a day trader. If you don't have a plan for that, you are an investor, meaning you're looking for a move, let's say 20 or 30% higher, which may come or may not come, but that's a reasonable goal for an investor that's going to sit in a position like this, I don't know, anywhere between 6 months and 2 years. I'm just throwing here numbers off the bat. As a day trader, you are observing, you are in front of the chart, and you ask yourself, okay, I bought at 28, I'm risking $200, how much do I want to get on this business transaction? My risk is 200. It's clear that I'm not going to lose money, but how much I'm going to make out of this position? If I'm making $1,000 out of a potential 5,000, is it a good business? If I'm making 2,000 out of 5,000 potential, is it a good business? Can I make 5,000 out of 5,000? And again, all these answers need to be answered by you, the day trader, okay? Because it's your money and your responsibility. And there are ways where you can obviously plan and execute plans, and one of the best attributes, amazing attributes of the US equity markets is, and we talked about it I think in chapter 2, is the liquidity. And if we look at this stock, AOI, Applied Optoelectronics, and 99% of US traders never heard about this company. It traded nearly 7 million shares in half a day on Thursday. So the liquidity is there. Means you can sell almost at every price those, let's say, 800 or 1,000 shares that you bought in this position. This is basically now, I'm complimenting and telling you, this is basically how the business of day trading is done. You enter a position, you assume the risk. If the trade is not working against you, you take the loss. If the trade works again with you and you have money in your pocket, the question is how much money eventually you're going to take from the business. You're going to take 20% of the potential or 50% of the potential. Okay guys, we're done with lesson number 4. I know it's a little bit tight with time. We'll see you in the next video. There will be a video number 5.